A mutual fund is a type of collective investment that pools the money of many people to buy a variety of securities such as stocks or bonds. When you buy a mutual fund share, you own a small portion of the fund's investments. Consider a mutual fund to be an investing basket. When you buy a mutual fund share, you are purchasing one share of this basket and thus own a little portion of the fund's investments. Mutual funds can assist investors in a variety of ways. They are a strategy to diversify your investments. Most are managed by financial specialists, and because of the variety of mutual funds available, investors can participate in a wide range of investment types. Let's have a look at how a mutual fund operates. Assume an investor wishes to invest some of his retirement savings in the stock market but lacks the time to examine individual stocks and establish a diversified stock portfolio. Instead, he decides to purchase a mutual fund. In this manner, the investor can purchase a single investment that is equivalent to acquiring a complete portfolio of equities. But which mutual fund is the best fit for him? To discover the correct one, he uses online tools such as mutual fund searches and ratings provided by independent third-party organizations to find a mutual fund that fulfills his investing goals. When he discovers a fund that appears to be a good fit, he reads the prospectus, which is the official description and explanation of how the fund functions. The prospectus contains a wealth of information about the fund, such as fees and charges, minimum investment amounts, performance history, risks, and other pertinent details. After reviewing the fund and its prospectus, our investor concludes that it appears to be a good investment. As a result, he invests the least amount required and buys mutual fund shares. By purchasing shares, the investor is now a part of all the fund's profits and losses. One advantage of this is diversification, which occurs when an investment or portfolio is dispersed across numerous distinct investments. This can help reduce risk. For example, if one of the fund's investment companies has a bad year, the impact on the fund's total assets may be minor, because that faltering company accounts for only a small portion of the fund's total assets. The fund selected by the investor, like most other funds, is actively managed, which means it is controlled by a fund manager or managers who buy and sell the fund's assets. Fund managers use financial research and professional skills to give the best possible returns to investors. While a smart manager may achieve significant returns for the investor's money, success is not guaranteed. If a management makes poor decisions, our investor will not receive the expected profits. Even if the fund underperforms, the management is still paid a charge, which is deducted from the fund's assets, resulting in even lower returns. Management fees aren't the only expenses our investor must bear. Aside from transaction costs, the fund may levy a sales load, which is a fee to buy or sell shares. Some funds also charge a fee if shares are sold within a certain time range. Now that the investor has invested in a fund, how can he profit from it? One method is through appreciation, which occurs when the value of the fund's shares rises. Typically, when the fund's assets increase in value, so do the fund's shares. The value of the fund shares, unlike stocks, does not fluctuate throughout the trading day. Instead, when the market closes, the fund's value is determined and updated. A dividend payment, which occurs when a mutual fund distributes a portion of its earnings to shareholders, is another method an investor might profit from a mutual fund. However, when the fund's assets fall in value, so do the fund shares, which is a danger of investing in a mutual fund. The variety of mutual funds offered is one advantage of mutual funds. Our investor chose a stock mutual fund. Almost every sort of investment, however, has a mutual fund. Equity funds, for example, invest in stocks, fixed income funds in bonds, and balanced funds in both. Some mutual funds may invest in an index as a whole, whereas others may concentrate on equities from a certain country or market sector. Certain funds also have distinct goals. Some investors may seek out riskier equities in rising industries, while others may prefer to invest in more stable businesses. There's a lot to learn about mutual funds and other investment options, and we've got the materials to help you get started. Check out more for our award-winning investing education. Thanks for watching, and don't forget to like, subscribe, and hit the bell to get notified of future videos.